Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden in plain sight between the lines of corporate filings. And today we're diving into something that might sound a bit niche, but actually has big implications for how certain digital assets are managed. So we've got VanEck Solana ETF or VESOL, and they've just filed an 8K report. Now, an 8K is basically a report of, hey, something important just happened for public companies. And what happened here? Well, it is all about a new trust agreement. Think of it like an update to the rulebook for how this particular ETF operates. This report is about the VanEck Solana ETF, which invests in Solana, a digital asset. The main players here are VanEck Digital Assets, which is acting as the sponsor, and CSC Delaware Trust Company, which is the trustee. They've updated their declaration of trust and trust agreement. So what are the key changes in this updated agreement? Two big things are being highlighted. First, they are clarifying the amount of SOL, which is short for Solana, that the trust intends to stake. Staking is basically how you earn rewards on certain digital currencies, similar to earning interest on money in a savings account. But with digital assets, this indicates a more defined strategy for how the ETF will manage its Solana holdings to generate returns. Second, and this is quite important for investors, they've added a provision that allows the sponsor, VanEck Digital Assets, to temporarily extend redemption settlement dates. What does that mean in plain English? It means that if investors want to sell their shares of the ETF, there might be instances where the fund can take a bit longer than usual to process that sale and give them their money back. This flexibility is usually put in place to handle unusual market conditions or operational challenges, preventing a fire sale of assets and potentially protecting the fund and its remaining investors from sudden price drops. Now, why would they do this for a digital asset ETF, especially one dealing with volatile assets like cryptocurrencies? Operational smoothness is key. Staking SOL means they are actively managing those assets. If there are any hiccups in the staking process or if the market for Solana becomes highly distressed, being able to delay settlements can give the trustee more breathing room to manage the situation without being forced to sell assets at a bad price. It is a risk management tool, but it does mean investors might not get their cash immediately in certain extreme scenarios. The ETF itself, known by its ticker symbol VESOL, is traded on the Nasdaq Stock Market LLC. This means it is a regulated product available to a wide range of investors. It is also worth noting that the registrant is identifying as an emerging growth company. This generally means they are a smaller company that gets some leeway on certain reporting requirements, aiming to ease the burden as they grow. They've also elected not to use the extended transition period for complying with new or revised financial accounting standards, which suggests they are aiming to adhere to the latest accounting rules sooner rather than later, which can be a sign of maturity and transparency. This updated trust agreement, which is filed as Exhibit 4.1, is the core document driving these changes. It clarifies how the trust operates, especially concerning its Solana holdings and the potential for delayed redemptions. Essentially, it is about ensuring the fund can operate smoothly, especially during turbulent times in the digital asset market. So, what is the takeaway here? This filing isn't a dramatic financial performance report, but it is a crucial piece of housekeeping for the VanEck Solana ETF. It signals a more defined approach to staking Solana, and, importantly, builds in a mechanism for the fund to manage redemption requests during extraordinary circumstances. For investors in VESOL, this means understanding that while the fund aims to provide exposure to Solana, there is a built-in buffer for the operator to manage stressful market conditions, which could mean a temporary delay in getting your money back. It's a sign of pragmatism in a rapidly evolving and sometimes unpredictable digital asset space. Now, looking at this filing through a Warren Buffett lens, we're not seeing revenue numbers or profit margins here. Instead, we're looking at the governance and operational stability of the fund. The real value in this filing lies in the trust and reliability it aims to build by transparently updating its operational rules. The weakness could be the inherent volatility of the underlying asset Solana and the potential for extensions impacting investor liquidity. The opportunity is for the fund to manage its assets efficiently through staking and maintain stability during market shocks, ultimately benefiting long-term investors. The significant risk remains the price volatility of Solana itself, which is outside the direct control of this trust agreement update, but is the ultimate driver of the ETF's performance. Alright, that is our breakdown of the VanEck Solana ETF's latest filing. What is your take on these operational updates and what they signal for the future of digital asset ETFs? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into the world of corporate finance. And don't forget to check out our Discord community linked in the description for more discussions and insights. Thanks for watching. See you next time.